The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Emerging markets are seeing a months-long rally, with currencies surging, local bonds seeing a wave of inflows, and equity benchmarks outpacing their developed market peers. But this momentum is unfolding against a backdrop of escalating geopolitical tensions, renewed trade policy uncertainty, and historically tight valuations, all of which are testing investors' conviction. So can this month-long rally continue? Where are the risks being underpriced? How sustainable is this rally as we head into the second half of the year? Well, to find out more, joining me now is Gary Tan, who's a portfolio manager for the Intrinsic Emerging Markets Equity team at Allspring Global Investments. Hi, Gary. Welcome to the show.
Hey, hello, Hongbin. Thanks for having me on the show.
Thank you so much for joining us. Gary, emerging markets have been on a stellar run. What's been driving this positive momentum? Has it been outperforming U.S. equities?
At Allspring Global Investments, our key message to investors is this. Emerging markets are no longer just tactical or valuation discount opportunities. They are becoming strategic allocation to long-term portfolios. So to your question, markets have gained momentum due to a mix of short-term catalysts and longer-term shifts. A weaker US dollar, falling interest rates, and the potential of a US-China trade deal have all boosted sentiment. Beyond that, structural drivers like digital transformation, younger demographics, and supply chain diversification are creating real opportunities. While the US markets have remained strong despite the relative global uncertainties, the emerging markets, especially in Asia, have started to outperform on a relative basis. Investors are recognizing that these markets are no longer just about cheap valuations. They're about innovation, resilience, and longer-term investment potential.
So are we in the early innings of a structural rotation into emerging markets, or is this just a tactical rally driven by dollar weakness and Fed expectations?
Yeah, that's a very good question, Hongdae. And from our side, we believe that we are in the early stages of a structural rotation into emerging markets. Despite the ongoing geopolitical tensions, emerging markets continue to attract fund inflows, while global allocation to emerging markets remain below pre-COVID levels. So as the global economy shifts towards a more multipolar structure, countries such as India, Indonesia are benefiting from robust domestic demand, while China advances its focus on innovation and self-reliance. Favorable demographics, rising foreign direct investments driven by supply chain reshoring, and accelerating digital adoption further reinforce the longer-term case for emerging markets. So yes, we are still at the early innings of this structural rotation into emerging markets.
Okay, some investors are betting the months-long rally in emerging markets has further to run, even as tariff threats and escalating geopolitical tensions signal a rocky path ahead. Do you hold the same view?
Yes, we hold the same view, but I think we kind of disagree on the investment approach that most of our investors are thinking. Yes, we do believe that the rally in emerging markets has further to run, but it requires a selective and active investment approach. Geopolitical risks and trade tensions are real, and they can create short-term volatility. That said, many emerging markets today are more resilient to macroeconomic shocks such as oil price fluctuations, dollar strength, and tariffs. I think what we're seeing today is the early phase of a longer-term alpha-driven rally, one that's not about broad market exposure, but identifying specific sectors and companies with structural advantages. Just as how the MAX 7 has driven much of the S&P 500's performance, we believe a select group of high-quality companies in emerging markets will lead the next wave of growth. So the way we approach this as Allspring Emerging Markets, we're not really chasing momentum or binary outcomes of macro events. We are focused on fundamentals, investing in resilient business models and sectors aligned with longer-term trends such as digital adoption, supply chain realignment, and rising domestic consumption. These are the three areas that we see sustainable opportunity in the years ahead.
Okay, so what are some factors that could help emerging markets to continue their stellar run?
Well, I think in the short term, there are several factors that could keep the momentum going. A weaker dollar supports capital inflows. A US and China trade deal can boost sentiment both domestically and internationally, especially on spending, consumer spending. But on the longer term rise, structural trends such as digital adoption, the rising middle class consumption, and foreign investments are accelerating. So at Allspring Emerging Markets, we're really focused on sectors such as technology, consumer discretionary, and dividend-paying companies that offer both growth and resilience during this time of uncertainty.
Okay, well, speaking of which, the weaker dollar narrative is playing a central role in EM optimism. But how much further do you think the dollar has to fall, and what does that mean for emerging market currencies?
I think that's a good question because the US dollar has already weakened, and if the Federal Reserve continues to cut rates, we expect further downside. I think it's overall consensus that is generally positive for emerging markets as the softer dollar reduces external debt burdens and support capital inflows. But what we kind of differ from consensus is that looking ahead, we expect more divergence among emerging market currencies, driven by structural shifts such as supply chain reshoring, de-dollarization, and rising of regional trading blocs. One clear example is the year-to-date divergence between South Asia and LATAM currencies, where LATAM currencies actually outperform South Asian currencies year-to-date, despite historically both of them being quite correlated to the US dollar. This shift actually highlights the importance of being selective and understanding how evolving trade and capital flows impact individual economies. So for us at Allspring, currency movement is not really a core driver of our strategy. We are focused on how they affect company fundamentals, especially on earnings and debt. While a weaker dollar can be a tailwind, our emphasis remains on resilient businesses with strong fundamentals that can deliver sustainable returns regardless of short-term currency fluctuations.
Well, with U.S. policy risks, though, including the debt ceiling and the return of Trump-era trade rhetoric, how should investors then think about the tail risks in emerging market assets?
Yeah, I think U.S. policy uncertainty has definitely been kind of the main headline this year, whether it's the debt ceiling, renewed protectionist trade rhetoric. This has real concerns for global investors as these risks can create volatility, especially for emerging markets with greater external dependencies. That said, at Allspring, we see emerging markets as a strategic counterbalance in global portfolios, as highlighted in our earlier key message. As the global economy becomes more multipolar, many of these markets are supported by strong domestic demand, improving macro fundamentals, and growing intra-regional trade, which helps buffer against external shock. And in this environment, it's also important to note that managing tail risk, as highlighted, is not just about protecting against downside, but also avoiding missed opportunities. By focusing too narrowly on U.S. policy risks, global investors that are not invested in emerging markets risk not fully capturing global thematic growth trends such as AI, electrification, and automation, especially as U.S. and China seek divergent paths of development in these key areas. And examples of this can be seen in the re-rating of the China internet names post DeepSeek and the emergence of BYD as a global EV maker overtaking Tesla.
Well, overall then, Gary, which regions or countries do you see offering the best risk-reward in the current environment?
In our portfolio, we see strong opportunities in Asia. India is recovering and offers really a long-term growth runway. We think Indonesia is undervalued and really supported by solid macro fundamentals despite the political headline risk. On China-wise, it's a bit more nuanced, but we see selective opportunities both in AI, automation, and electrification. We think that China is going to be less of a beta-driven kind of market and more alpha-driven type of market where stock selection remains key. So overall, we believe that a bottom-up selective approach is a key to unlocking value in these markets.
Well, Gary, some analysts say traders will need to hold their nerve going into the second half. What are your thoughts? Will it be a bumpy ride for emerging markets?
I think overall we think that emerging markets in the short term may see a challenging period ahead with heightened volatility driven by shifting Fed policy, geopolitical uncertainty, and trade dynamics. While this environment can be unsettling for some short-term investors, it presents selective opportunities for longer-term investors. For those underweight the asset class, we think that current market dislocations offer a chance for them to gradually build positions. For existing investors, we think that already invested in emerging market, we think now is a prudent time to reassess allocation, considering trimming positions where valuations appear stretched and rotating into higher quality names, particularly if they are trading at compelling prices due to market dislocations. So for us at Allspring Emerging Markets, our investment philosophy is really rooted in quality. We maintain a quality pool of high conviction stock and are prepared to act decisively when compelling opportunities arise. Buying quality companies at a compelling price is really core to our investment process, And overall, the key for investors is to stay invested, remain selective, and to keep a long-term perspective.
Well, since you said it is a good time to think about emerging markets at the moment, how should investors then be thinking about positioning in the next few months?
Well, I think beyond the usual focus on Fed policy and China's stimulus, I think this kind of fairly consensus points that investors are looking at. But we'll highlight a couple of under-radar developments that could shape emerging markets in the coming week. Firstly, we think commodity diplomacy is quietly evolving. New trade alignments and pricing strategies among key producers, particularly in critical materials and energy, could shift sentiment in favor of resource-rich markets such as Brazil and Indonesia. Second, AI adoption in emerging markets is accelerating. While US tech companies dominate the headlines, we're seeing meaningful tech innovation in Asia and Latin America that can lead to upside surprises in selected technological sectors. Therefore, we should position ourselves well in Korea and in Latin America. Yeah, and thirdly, of course, political recalibration in countries such as South Korea and Mexico are currently flying under radar, and we think that investors should be well positioned to take advantage of that. I think overall these developments are more than just short-term noise. They kind of reflect the deeper shifts as the world transitions to a more multipolar order.
All right. Well, before we let you go here, Gary, what else should investors keep a lookout for in the coming weeks that could influence emerging markets?
Well, overall, I think at this stage, we believe that we are at an important global inflection point for emerging markets. So our advice for investors is really to stay invested, stay selective, and really focus on fundamentals. So for our side, our intrinsic bottom-up approach is built to navigate complexity and uncover overlooked opportunities to deliver sustainable alpha throughout cycles. And this is how we think we can help our clients unlock the full potential of investing in emerging markets.
Some great insights from you there. Thank you so much, Gary, for joining me today.
Thank you, Hongbin. Appreciate the time.
That was Gary Tan, who's a portfolio manager for the Intrinsic Emerging Markets Equity team at Allspring Global Investments. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.